Hello, everyone. My name is Gina Ciencio. Welcome to the Counterparty Credit Risk Management three-part webinar presented by Double N Advisors, Pangea Business Solutions, and Alliant Insurance Services. Over the next hour, you'll hear from three experts in this field, Carl Versella, J Caruso, and Paul Grassi. At this time, I'm going to turn it over to our presenters. Carl?
Thank you, Gina, and welcome attendees for joining us for this three-part webinar series on Counterparty Credit Risk Management, co-sponsored by two of DNA's cooperative companies. This series will focus on the important aspects of a solid CCRM program from the investment manager's perspective, not the banking perspective. We will also touch upon the insurance implications of an effective program. And today we will cover an overview of this three-part series. As there are three parts to this, stay tuned for future parts later in May and June. We will have polling questions, which we would like everyone to participate in. Please provide your answers, and we will receive immediate results afterwards, and they will be displayed for everyone to see. But first, let's have a brief introduction of our presenters. My name is Carl Versella. I am the founder and CEO of Double N Advisors. I've been fortunate enough to be at a number of different firms, both on the buy and the sell side: Goldman Sachs, Morgan Stanley, Credit Suisse, which is a topic of discussion for later, along with hedge funds, Tiger Management, and started my own consulting practice. And migrated from KPMG to DNA as I am now. Our practice is for alternatives and the service providers that service them. And I'll turn it over to Paul Grassi to talk a little bit about him. Paul, you want to unmute?
Thank you, Carl. My name is Paul Grassi, and I am a Senior VP and shareholder in Alliant Insurance Services, and my focus is also on the alternative asset space. We focus primarily on professional lines of coverage such as E&O, D&O, cyber, crime, and the like, employment practices, fiduciary liability, and things of that nature. Alliant Insurance Services is nationally ranked. I believe we're either 6th or 7th largest by written premium. And we have a very strong team that builds on a broad background. My personal background is as a CPA, which I worked in that space for about 20 years, and now working in the insurance space since the .com era, and have partnered up with Carl and Chris to discuss the whys and wherefores of credit and counterparty risk. Chris?
Thanks, Carl. Yeah, my name is J Caruso. I'm the founder of Pangea Business Solutions. Pangea works with hedge funds to help them better understand and manage their counterparty risk. We have a number of different product lines to help them do that. I was in the banking business for 30 years, half of that in prime brokerage. Most of my career was at Morgan Stanley and Deutsche Bank. Deutsche Bank was my last stop in the banking world, where I was responsible for the U.S. prime brokerage business there. So this webinar is very timely and very close to my business, and certainly to the current events that we're going to be speaking about. So, Carl, I'll turn it back over to you.
Thanks so much, Chris. Today, we're going to cover a number of elements in part one and talk about the goals of an effective CCRM program, regardless of your size. We're also going to touch upon how and where a CCRM program affects the people, process, and technology of your organization. We'll do a brief history and evolution of CCRM, go through some of the fundamentals of prime brokerage, ISDA, and term agreements and other essentials. And then we'll end with some counterparty agreement takeaways. And I think this is important to note that from our perspective, you start mitigating some of your risks through looking at your counterparty documentation. Part 2, which will be in May, is going to focus on communication and reporting. How do you communicate effectively with your counterparties? What kind of information do you need? The due diligence you should perform on counterparties, the types of relationships that you have with them, and also what kind of metrics should be utilized in order to monitor this on an ongoing basis. Part 3 will focus on how do we put this all together. Regardless of size, it's important to have some effective Ccrm program, and we'll effectively help you get to that point in part 3. We'll also talk about how you monitor credit metrics and decision-making processes within your organization, as well as monitoring relationship metrics. What are the things that you need to look at outside of CDS and general ratings? We'll also take an approach on vendors and give you some pros and cons and how you can facilitate some of this through vendors out in the industry. But first, I think it's important that we talk about the goals of a solid Ccrm program. And, this goes beyond just knowing your coverage, that you understand all the risks embedded with your counterparties. It could be their risk management capabilities. It could be their leverage extension and their ability to provide operational expertise. All of that should be factored into understanding and knowing who your counterparties are. Outside of your investors, liquidity is the lifeblood of your business. Understanding how margin changes and the liquidity that you have is extremely important. How you can optimize and finance your leverage. It's so important to stay informed and be proactive. I always, as a Tiger management running of the credit portfolios, it was important for me to understand how much excess we have on a daily basis, how it's changed, where it has changed, and at that point, really understanding if Julian Robertson wanted to go out and buy a baseball team, how much money does he have? It's also important to stay informed and be proactive. Know your metrics. Understand what the good, the bad, and the ugly are. Be proactive with good and bad news with your counterparties so they stay informed, and vice versa. This is a two-way street. This is no different than performing fundamental research on a company that you want to invest in. You need to do the fundamental research with counterparties, and you need to understand their relationship in a variety of different perspectives. And also, one of the goals would be to be in the best possible position with counterparties to win and grow your business. Plan for the future. Understand what your counterparty documentation has as a starting point. And then I think the next two are very much tied together in the sense of understanding what your exit strategies are. I can give you anecdotally a situation back in 2008 where I was doing advice for a $10 billion hedge fund, heavily invested in Morgan Stanley. This was at the height of the Lehman, Bear Stearns, Goldman Sachs, Morgan Stanley credit crunch. And every day we talk about, we had 40% of our investments in financing at Morgan Stanley. How do we get it down to 30? How do we get it down to 20? How do we get it down to 10? And those kinds of conversations, you certainly don't want to have happen at the time of a crisis. You really want to focus on those situations way before that and have some optionality on the counterparties that you're going to use and how you're going to use them. And I will turn it over to Chris to give his perspective on some of the points that we're listing here.
Thanks, Carl. Yeah, a few things here. Going back to the, knowing all your risks, I think it's important to view counterparty risk management holistically. I mean, there's a broad range of risks. And at Pangea, I like to say, anything that counterparty risk is really anything that your provider, your credit provider, your custodian can do to materially disrupt your business. Now, certainly going out of business is very disruptive, but there are a lot of other things too, like there's regulatory risk, operational risk, information security risk, and certainly companion to that is cybersecurity risk. I mean, these are all things that you need to take into account, as well as some of the more, less obvious ones like relationship risk. Who do you know, and who are your relationships at these counterparties? How senior are they? Because when things get tough on one side of the fence, whether it's your side or their side, or in 2008, both sides, who you know and who will pick up your phone call is very important. So we look at a continuum of risk. We look at it very holistically. Second point I would make is on this, knowing your metrics. A lot of hedge funds you'll talk to talk about CDS spreads, they talk about stock price and things like that. I think it needs to be much broader. I think you need to be thinking about a broader range of metrics, the Basel III metrics, profitability metrics, all of these things, and on a regular basis, not just ad hoc, not just when there's a problem. There should be an ongoing process every quarter when the earnings come out. This is one of the products that Pangea provides, which is to kind of go through this in a deep dive every quarter so that you have this information at your fingertips when you need it, and it's never more than a quarter old. The last thing I'll touch on that Carl spoke about was these what if credit scenarios. And certainly his example of what was going on in 2008 is a perfect example of what you want to try to be ready for. And again, that's the key thing, be ready for, be prepared. There's so many things you can prepare for ahead of time. So when a crisis hits, you don't have to be scrambling to find the things that you should have been able to prepare for. That's things like, who the people that are going to be involved on your side. What's the data and the reports you're going to need? Who are the people you need to call on both sides? The people you're leaving, the people you're going to. If you can get all these things ready, then you can free yourself up to deal with the things you can't prepare for. Kind of the fog of war, so to speak. So I think that's it. The thing that's challenging though for most hedge funds is capacity and resources, right? Only the largest hedge funds probably have the capacity to do this, and maybe not even them. So I think that's the challenge to it, but it's something that needs to be thought of, and a plan needs to be, you need to come up with a plan for it. Carl?
Very good points. Paul, is there anything else that you'd like to add?
Yes, thank you. Obviously, the risk management that goes with setting up proper counterparty protocols is designed to prevent catastrophes and losses and things. And we'll talk about some of that later on. But insurance is a great way to understand how you can minimize your exposure to not only performance, but liquidity in and of itself. And while the actual counterparty transaction itself is not insured, the hit to the fund, if that transaction or transactions goes bad, can be mitigated somewhat with the liquidity provided by a claim that may be on a policy. So it's important to have a policy that is addressed towards your professional services that include the things that you're doing. It can bolster the balance sheet and the effect of a loss, and mitigate some of the negatives to the performance that you might find.
All very good points. I would add one final item here is that providing senior management or key stakeholders or the PMs or whoever else is making the trading and investment decisions with timely periodic management reporting is also a key component, because you want to be able to arm them with these points that may create a certain level of risk. The last thing you want to hear from your head PM is, how come I didn't know about this? Or that they don't understand the risks going in. So, everyone's big enough in this industry to understand if they want to do business with a particular counterparty, but if they're not armed with the appropriate information, it gets that much more difficult in times of stress. Okay, good stuff. Let's talk about our first polling question. How often do you monitor the financial health of your financing and custody counterparties? Daily, monthly, quarterly, annually, or ad hoc? Please respond, and we'll get the results as soon as you have submitted your answers. Okay, don't be shy. Okay, so what seems to be our results at this point? Okay, so no one's doing it daily. About 50% are doing it on a monthly basis. Annually and ad hoc seem to be the predominant choice in this regard. So that's interesting to know. Very good. Thank you so much. Let's move on to our next topic, which centers on who's affected by a Ccrm program. In this case, we're breaking it into people, process, and technology. And if you look at the people side, you see that there is a variety of responsibilities where a Ccrm program could be affected, from the trading all the way down to middle and back office. And some funds actually, people wear multiple hats in this regard. But the reality is it touches upon a variety of different places within your organization. And we'll graphically represent that a little bit further on when we look at counterparty documentation. So keep that in mind, that there is expertise that's necessary across the board. From the process side, I'm going to hand it off to Chris to talk a little bit more on the process side and how it's effectuated and part of a Ccrm program. Chris?
Thanks, Carl. Yeah, I think the point I'd like to make is more from a high level. And I mean, one of the big changes in the past 10 years has really been the general acceptance in the industry, investors, regulators, with outsourcing. I think, the first example of this was probably back almost 20 years ago when administrators started branching into middle office services for hedge funds and things like that. But it's really accelerated. There's almost nothing that can't be outsourced at a hedge fund these days, which gives them, a tremendous amount of leverage, operating leverage for their businesses. And the other thing that's driving that, especially on the technology side, is that there's a general scarcity of technology resources for the business side of the hedge fund. And that would include the CLO's world and the treasurer's world. So it's hard to get things built internally as well from a technology point of view. And I think, you'll see a number of these products are quite helpful. We're going to be talking a lot about, agreements and the like, and there's companies that are out there that are providing technology solutions to things like key terms tracking and things like that. There's a number of providers also that provide very sophisticated tools for the treasurer, for collateral management, monitoring securities lending, actually executing the transactions themselves, which again gives you tremendous amount of operating leverage and levels the playing field for a number of funds that don't have the resources to build this themselves. And even the ones that can, I think are opting out. I remember having a conversation with a very large equity long short manager a number of years ago, and he was asking me for recommendations of funds that provide treasury products and the like. And I was like, well, why? Just build it yourself. You know this better than anybody. He goes, well, I can't get the resources. Right? They're building risk systems and trading systems. I can't get the resources to do it. So even the largest funds are taking advantage of, again, this general acceptance of outsourcing in the industry. Carl?
Yeah, so part and parcel of that is also understanding what's out there from an outsourced or an insourced basis. Some funds have decided to build this on their own. Some funds are using outside technologies and sort of white labeling it for their own benefit. But some of the major areas where you see this is in cash and collateral management, securities lending and borrowing tracking, counterparty documentation, margin calculators. One of the most significant liquidity risks that funds have is not understanding how their margin is calculated, and we'll get a little into that through some other slides. But I think it's important to note that this is a continuum that's evolving. There are more and more technologies and vendors that are coming to market, but the process and the people side of it is the same. All of these processes and these people are affected. And it's our job as advisors and it's our job as fund managers to figure out how to bring it all together. Paul, do you have any commentary on this slide that you'd like to share? Paul?
Discussion. I was going to get into the legal structure angle of things, but I think it's more appropriate in a later slide to talk about that.
Okay, fair enough. All right, let's go to another polling question. As a part of a broad risk mitigation management program, have you considered outsourcing compliance, partnered with a subject matter expert, transferred some risks to an insurance product, or all of the above? Weigh in. Let us know what you think. Okay. Considered outsourcing compliance and partnered with a subject matter expert seems to be the predominant source, and that's good to note because obviously leveraging the industry would be important, but I'd also consider looking at how you mitigate some of that risk through insurance products. Okay. Let's move on to a little history lesson on the evolution of counterparty credit risk management. Prior to 2007, this was mostly a sell side discussion. And pre-1998, generally you had easy credit extension, but then certain events occurred that woke up the industry. And, you had things like a Russian default and Enron, the long-term credit bailout, and then the president's working group on hedge funds was established. Who are these hedge funds and what are they doing and how much leverage is employed in the system? And from that perspective, you had a moderate credit tightening to a credit tightening as firms knew and understood more and more of the impact of leverage on the financial system. However, we didn't learn that lesson and keep it close to the vest. We sort of had a situation between 2000 and 2007 where off-balance sheet products proliferated. Repo happened, but Wall Street was getting too smart for their own good, and they were leveraging leveraged products and selling it on an off-balance sheet basis. We all know what occurred from that. And, the Great Recession occurred. Prime brokers were under siege. We had MF Global and Bear Stearns. And, what's important to note is that in this 2008, 2012 timeframe where we saw severe credit tightening, some companies like AIG and JP Morgan had more CDS exposure on companies that failed than the market cap of those companies combined. So think about the leverage on the leverage that was employed in that period of time. That's essentially why we had this breakdown of credit. And now we'll talk about Archegos in a second, but today we see other issues that could severely hamper credit, and you've seen some credit tightening from COVID, from some FCM defaults, the economy under siege last year, recently Archegos, and there is a bit of credit tightening that will continue to occur. And I turn it over to Paul first to talk a little bit about it from the insurance perspective, but it's important to notate, what the insurance impacts were in that period of time.
Thank you, Carl. When I got involved in selling insurance products to the alternate asset space in around 2001, the penetration of those products among funds was rather limited. I think for the most part, the fund managers did not see their exposure as all that great. They had great indemnification agreements in their investor agreements. The SEC was not very robust in their oversight of hedge funds. Hedge funds were, a relatively emerging entity. By the time you got to 2008, obviously there was a major paradigm shift. The insurance industry was expecting just an avalanche of losses as a result of funds that were closing down, losses that were happening, gates that were put down, investors that couldn't, realize the liquidity that they were hoping for. But an interesting thing happened. A lot of the funds that were losing money did not purchase the insurance. So there was not this preponderance of insured losses that the industry was expecting. But the die had been cast, and fund managers since 2008, the penetration of managers and firms that have purchased this product has becoming much more universal. European fund managers had purchased this coverage in a much broader scope than Americans. Americans have been catching up with them over the last 12 to 13 years. And following, I'd say 2011 or 2012, it was a relative period of calm. There was a lot of capacity in the marketplace. This insurance, which had been very expensive and rife with a lot of exclusions that prevented real coverage, the coverage was advancing, the premiums were coming down, retentions were reasonable, and a lot of people were buying it. Fast forward to about 2019, and the industry as a whole is suffering through catastrophic losses, not necessarily in a financial institution space, but with hurricanes and tsunamis and wildfires and things of a catastrophic nature that is causing the entire industry to reset itself. So we've seen premiums and policy terms and conditions, what we call hardening up, since about 2018, 2019. COVID has certainly enhanced that posture, because suddenly you have governments trying to override policy terms that prevent coverage for viruses and things of that nature that don't exactly injure the property that firms have. But we see that starting to change, and we're optimistic for 2021 going forward. Luckily, we haven't seen a dramatic change in the actual terms of the policies. They're still as robust as ever. It's just more difficult to get pricing concessions than we were able to just two or 3 years ago. Back to you, Carl.
Thanks, Paul. That was very insightful. Chris, any other commentary on this page?
Well, I mean, the timeline is interesting, and I'd like to talk to Seth for a moment about the Great Recession, the financial crisis of 2008, as a real education moment for hedge funds about their prime brokers and how they work. I mean, that was the big lesson on that Monday morning in September of 2008 when everybody came to work and they were trying to figure out exactly where all their assets were at Lehman Brothers. And the seeds of that were actually planted in 1996 when when Congress passed the National Securities Market Improvement Act. And buried in there, in that act, was a couple of things which permitted U.S. broker-dealers to arrange for third parties to lend securities to close out their clients' short positions. Basically, they built arranging, which created the prime brokers embraced this as a way to get leverage beyond Reg T. And then also in the act was another clause or another section which said that if clients could obtain regulated extensions of credit from entities other than their prime brokers, if they complied with the margin regulations. So this unleashed not just additional leverage in the system, but it also introduced different entities, legal entities that you dealt with. So when you opened up a prime brokerage account, you just didn't open it up with a broker dealer anymore. You opened it up with, another U.S. broker dealer, a foreign broker dealer, a foreign bank branch, or something. So you had multiple entities involved in your prime brokerage business, in your prime brokerage relationship. And as you booked your trades, they started moving around to all sorts of different entities and legal jurisdictions, and no one understood that. No one understood rehypothecation. No one understood anything. So they woke up on that Monday morning in September of 2008, and their assets were everywhere. They were in UK broker dealers. They were in foreign bank branches. They were everywhere. So they didn't understand the financing, the position booking, the entities they faked, the bankruptcy rules were different. Everything was different. So Lehman Brothers is out of business, right? And they say, okay, well, I've got SIPA coverage in the US with my US broker dealer. Well, that's fine, but your assets are over in the UK, right? And there's a whole different bankruptcy regime going on over there. So everyone got, all of a sudden everybody become very interested in how prime brokerage worked. And I think that was a good thing, because I think, as some ad used to say in the old days when I was younger, an educated consumer is our best customer, right? So, and I think that helped a lot. And every crisis, though, when you think about this, seems to bring on, some changes to the industry to tighten up things that were too loose. And certainly what was too loose in this instance was people didn't understand how it worked. And that lack of knowledge will definitely hurt you.
Yeah, very good points. And just to touch upon a little bit of what's happening today in Archegos, one of the questions that we got from some of the participants was, well, why don't we look at credit like Las Vegas looks at credit, and be able to understand exactly what's outstanding for any particular person at any particular time. Well, there are companies now that are doing sentiment and understand the question of what are the real ratings of these entities that credit is being extended to. And I will tell you, from looking at some of that information, it's clear to me that Archegos was one on the downturn in January, February of this year. Archegos occurred because there was a failure in escalation. There was a failure at the prime brokers to be able to understand the body of work of what was being financed, and there are clearly signs that everyone was looking at, but they did nothing about. And that is, from our perspective, even more important, that we take these lessons that we've learned over the years and even today, and understand that credit is always in flux, and the buy side is the most vulnerable in times of stress, because they're the ones that are getting the credit extended to them. So it is incumbent upon that constituency to make sure that they understand what the moving parts are, and understanding, just like Chris had mentioned, that the financial crisis of 2008 was a pivotal point, not just for the buy side, but also for taking, a counterparty credit risk paradigm as part of your day in the life and what you do, as important enough that investors started to demand it. And I think it's important to notate that there is a demand for some appropriate due diligence on credit counterparties. How do funds mitigate some of the risks inherent in your business? And I think with Basel III and the invention of balance sheet constraints, it's not only are counterparties too big to fail, but are you too small to service? Are you going to get the balance sheet that you need and where you need it from the providers that you need it from? And that's always changing. So being on top of that and understanding those balance sheet constraints is also something that needs to be factored in. And the need for insurance, we think is vitally important. Paul, you want to add anything else to that?
Yes, I want to kind of step back slightly into what Chris was talking about with the domicile of where your contracts may be, and the proliferation of special purpose vehicles and things that are on your balance sheet that might not necessarily have a clear path to your invested first named insured. So it's very critical when you have a policy that protects you, that the carrier is aware of all the domiciles that you are doing business in, so that you have coverage in those areas. Certain locations like Luxembourg, Hong Kong, UK, Israel, and such may require what's called locally admitted paper, which means that you want to have a global carrier like an AIG or a CNA, or a Travelers that's able to have UK paper specifically to address those losses. So if you have a claim in that jurisdiction, the local laws may prevent a US carrier from paying out on a claim. So you want to make sure that your broker is familiar specifically with all of the entities that are in your org chart and all of the domiciles that those entities might be transacting business.
That's great, Paul. Chris, do you have anything else to add on this page?
Well, I think, if we stay with the timeline a little bit from the previous slide, what happened after the financial crisis was kind of twofold. One, first you had an onslaught of regulation like Basel III and Dodd-Frank, which really focused on the capital and liquidity of the banks, of the GSIBs, the major systemically important banks. And on the other, and that create, the banks kind of go kicking and screaming into any kind of regulation like that. And certainly there were unintended consequences certainly something like the supplementary leverage ratio fell more heavily on prime brokerage than was intended. And for a period in the mid-teens, the prime brokers took the return on assets metric very seriously, and were quite draconian with their clients for a while. They've kind of evolved and gotten to know this better, and it's become a much more kind of baked in rule. However, as of March 31st, the relief that the banks got on the SLR last spring during the pandemic has rolled off. So again, there could be more pressure on the prime brokerage businesses. The other thing that happened after 2008 was industry innovation. I mean, the US introduced portfolio margining, which now gave them a product where on the US broker dealer, you could get up to 6 times leverage, which really, kind of blunted the need for having to go offshore or use onshore broker dealers to arrange your securities, unless you needed more gearing than 6 times. And a tremendous amount of clients didn't need more than that. So they could simplify, the entities that they faced. And the last point I'd like to make is to go back to the regulations that we just talked about and to talk about the events of 2020 and early 21, which was the pandemic put tremendous amount of stress on the US banking system and the international banking system, and the capital and liquidity held, right? They took tremendous amount of reserve losses. They were under pressure from their corporate and retail clients. The capital held up. Now we have Archegos, in March of 2021. And again, despite the losses at places like Credit Suisse, and as we recently learned, Morgan Stanley, the capital held up again. I mean, there was almost no impact on Morgan Stanley's capital from that loss. And there was probably about 100 basis points impact on Credit Suisse's capital from this loss. So we'll find out more details from this on Thursday. So again, I think these the regulations that were put in place, though the banking industry is not very welcoming of them, and they certainly had their unintended consequences and need some tweaking, which is unlikely given the political environment we're in. They generally have been a good thing for the industry in terms of having the participants feel much more secure about their counterparties and having absolute metrics that they can monitor, right, that are published. And there's a tremendous amount of metrics too, both in capital and liquidity and funding that they can refer to on a quarterly basis to see how their banks are doing.
Great. And I think we're now going to get into some of the fundamentals, and it starts with your counterparty agreement. So let's go right into that. You know, we've talked a little bit about some of the financing mechanisms, bridging agreements with other agreements, arranged financing, securities lending and borrow. Securities lending and borrow is basically, you know, you're lending your long portfolio to another broker dealer and borrowing against it, and it's a way of turning it into a loan versus borrow as opposed to regulation T or portfolio margin. But you also have the advent of portfolio margin. All of these conduits for financing, all these mechanisms for financing, it's important to understand who and what is providing the financing on these various types of financing mechanisms. And each comes with its own unique set of challenges and counterparty structures that are important for you as a fund manager to understand. There's also the concept of term agreements. If you're fortunate enough to get term agreements, it limits your downside effect of liquidation by the prime broker, because it gives you a certain period of time before they have to change margins or liquidate positions. But there are a bunch of excluded positions in these and caveats to these term agreements. And if you're fortunate to have them, then you need to monitor them as well. And obviously, if you're doing any sort of OTC business, you're dealing with schedules and credit support analyses that are basically geared towards a master agreement. The schedule basically outlines all of your legal risks. Your credit support annex outlines your cash and collateral management risks, and the DF protocols, which are recent within the last 4 or 5 years. There's a whole set of protocols that you need to follow to do OTC business, all of which have embedded risks associated with them. Obviously, another conduit to these types of risks are repo agreements, and you know, whether or not you're doing overnight versus longer term are key considerations. The most important thing with any of these agreements, outside of what entities are using, is are the risks, like as an example, an event of default, match to your other agreements? Invariably, they don't. And you need to make sure that they are realistic and similar, so you don't run the risk of having, let's say, an event of default in a repo agreement that's not outlined somewhere else. And of course, there are custody agreements for hedge funds, mostly, unless you're 40 Act constricted. Custody agreements are good use for asset protection, protect those assets that are unencumbered. But there is a need to understand, again, the risks associated with them and the fees associated with it. So, Paul, I'll turn it over to you for any other commentary on this page.
It's not directly related. However, it's important to note that these policies that provide for performance recoveries, I'll call, there is a provision called cost of corrections, which means that if you unintentionally, I mean, the entire policy is considered an unintentional errors and omissions policy. But if you, let's say you trigger a trade that gets you into a bad position with your counterparties, or just triggers a loss, and you realize that the trade was incorrect, you can correct that trade or other breach that you made without having to have a lawsuit initiated to recover policy claims. So it's important to make sure that you have the best possible terms to protect yourself from trading errors, in addition to other losses you might sustain as a result of the agreements that are listed on this page.
Great, thank you, Paul. We're now going to go to our next polling question, which is how many credit counterparties do you currently utilize for your business? And this includes all the financing conduits, prime brokerage, if you use custody, OTC, and repo. 1 to 3, 4 to 6, 6 to 10, or over 10. Predominantly in the 1 to 6 category. That sounds about right to the audience that we have. Obviously, the more counterparties you have, the more need for this counterparty credit risk management function. Okay. We are getting close to the end of the hour, so I'm going to power through some of these slides. We're almost there. Fundamentally, if you look at counterparty documentation and you look at the risks embedded in counterparty documentation, we sort of itemize these over DNA has cataloged many of these critical risk factors and categorize them as to who is most impacted for these risk factors embedded in documents. We've looked at over 200 of them over the course of us negotiating, managing, and normalizing risks for our clients. And you can see a big part of it is treasury and collateral management. But if you look at all people that we had on that people page of where it affects, you can see that there's a good percentage that cuts across the entire organization. And if you look at the types of agreements where these risks lie, some of them are duplicative but still embedded in them. A majority of them are in all agreements, almost 40% of them. So it's important to recognize if you have multiple agreements with a particular counterparty or multiple counterparties, you probably have a lot of these risks embedded in various locations. Okay. Continuing on with some of the fundamentals of counterparty agreement risks. We're going to touch upon a few of them. These are just a tip of the iceberg of the things that we can look at. Obviously, some of the easy ones to talk about would be key man provisions and NAV triggers. And just for those who need to understand it a little bit better, NAV triggers are triggers that your NAV declines over a certain period of time, over a certain percentage. Could be monthly, could be quarterly, it could be yearly. It could be a rolling 365 day, could be a rolling quarter. Understanding how that actually is put in your documents and what it looks like comparative to not only a particular counterparty, but all your counterparties is clearly a place that you want to make sure you get the best terms you possibly can. I'm going to turn it over to Chris on some of the other items. Chris, you want to talk about other things?
Thanks, Carl. Yes. Couple of things here that I just quickly want to mention. When you're negotiating, and we're talking about all these agreements, and it's very complex, you know, depending on the number of products you're trading and the entities you're facing off to. But it's really important for hedge funds to understand the negotiation process and what they can ask for based on their, you know, where they are in the evolution of their fund. Are they a new fund? Are they emerging fund? Are they a mature fund? You know, large AUM, not so large AUM. That can make a difference in what you can ask for. So you need to know in these agreements what you definitely have to have, right? And that's where you dig your heels in. And you're kind of going to have to let, in certain times during your evolution, you're going to have to let certain things go because you can't negotiate this document like you're a $10 billion hedge fund if you're a $500 million hedge fund. And that's the first point there. The second one I would say is related to that is, you know, multi-prime has certainly become something that's being re-examined a little bit now with Archegos, but you know, it's been since the financial crisis, hedge funds are using more and more providers from the start, and I would advise them to consider that you need to balance the counterparty risk elements of of diversifying your counterparties with multiple prime brokers with what you have to pay these people. So risk versus wallet, and that's going to help you. You need to be significant, but you also need to balance that with controlling your risk. And so maybe 2 primes to begin with, eventually becomes 4, maybe eventually becomes 6, but shouldn't start out at 4 or 5. And lastly, I think I would say is it's really important for hedge funds, especially as they get established with multiple providers, to have a relationship with the hedge fund credit group and be very proactive with that group, especially in times of stress. Develop your relationships with them, have a dialogue with them, so that when things start to be, if you do enter a period of stress, you know these people, they know you, you're forthcoming. They will, if they don't know what's going on, another great saying somebody once told me was, uncertainty is always perceived negatively, right? No one ever says, I don't know what's going on, I'm sure it's good for me. No, they say, I don't know what's going on, it's probably bad. And so if you can kind of get out in front of that, the hedge fund credit group could be your friend. Carl?
That's a great point. And it actually folds into part 2, which is the relationship management and due diligence part 2 that we're going to have in May. Chris, Paul, any additional points to add to this page?
No, I have some comments to make on the next slide after the next polling question.
Okay. So let's look at some of the key takeaways with counterparty agreements that I think extremely important to make note of. First of all, you're only as good as your lowest common denominator in your agreements. If you have multiple primes or multiple OTC counterparties, and let's say you have NAV triggers that are different, yes, you may have gotten better terms with one, but the other one is lower. You're only as good as your lowest common denominator. So try to normalize some of the risks across your counterparties where feasible. This also makes for a better process because you'll know, we negotiated X with all our counterparties, and that's what we can hang our hat on. The second is to know your counterparty legal entity structures. So I'm going to give you 2 numbers, 14 and 240. 14 is the amount of main banks and prime brokers in North America. 240 are the legal sub entities that those 14 main banks and prime brokers have. Now, probably not all of them are doing financing type business, but think about that. There's 240 sub entities that potentially could house your business. Understand who those counterparties are, and understand where your risk lies in terms of what countries and the risks embedded in your portfolios. As you change or as you grow, or as you may get addendums to agreements, make sure that you monitor and update them all. And so you can, on a fly, understand and manage exactly what's being, what coincides in the marketplace and whether or not certain things will affect you, whether it's negative on your side or negative on the counterparty side. And Chris touched upon this, and it's important for everyone to understand. You cannot negotiate as a $10 billion hedge fund if you're 500 million, but you certainly should understand what you can get and negotiate counterparty agreements for future growth. The last thing you want to do is have to go back to counterparties and change agreements that you already negotiated. That's a much harder sell to do. So keep that in mind when you're in that portion of your negotiating process. I think it's also important to note that there are high risks embedded in these counterparty agreements that are more or less sensitive for your business. Identify them, proactively manage them, make sure that you've itemized that appropriately. It goes back to our management reporting aspect of things. Make sure that your head PMs and everyone else that it affects understands them. And the last thing that I would say, even if it's in an Excel file, is document the key terms as a reference for key stakeholders. Chris, anything else to add?
Thanks, Carl. When you go back to Carl's number of 240 legal entities underneath the parent of all these banks, it reminds us that as you are negotiating these documents, figure out who you're negotiating with. Point two here, the legal entity. Who are these sub entities? Are they regulated, or how are they capitalized? Where is their jurisdiction? What's their role? What are they doing? Are they holding? Are they extending credit? Are they holding your securities? What are they doing? So that's the one thing I would say there too. And I would just add to, lastly, I would just add to what Carl said about kind of getting what you need for future growth. The flip side of that is future growth is hard to figure out, right? You don't know how you're going to look in 5 or 10 years, and with every prime you add, you could wind up 5 or 10 years down the road with agreements that are quite different from each other depending on which counterparty you're facing, and when you added them during your life cycle, right? So at some point, and as you get bigger, then you probably will actually have people that work. You'll actually have a legal department, so you'll have people to kind of go back and say, well, we should normalize these agreements because they're really different. My $500 billion agreement looks a little bit different than now that I'm $5 billion. And my experience is that large hedge funds will do that. They may do it on a rolling basis with everyone, or they may just do it on a retroactive basis, saying like, okay, they wake up one day and they say, I've got these agreements, and they're all radically different. I've got to normalize them.
Or you can come to,
and that's a good problem to have.
Yeah, you can come to us as advisors to help you with that as well, because we've seen that and helped many funds that have grown over their life cycle and need to really normalize all of these exposures. Paul, any other additional points?
Yeah, thank you. That's a great lead-in for me. Don't neglect the opportunity to take advantage of your insurance professional as relates insurance requirements that any of these contracts may have. I can't also stress enough how important it is that the legal entities that you have internally and the legal entities that you're dealing with externally through your contracts are picked up by the policy language, terms and conditions, like everything else on these agreements. These policies are legal contracts with specific terms and conditions. And it's very important that these things are not missed. And the best way is to stay in touch with your broker on the kinds of business that you're going through. And if there's any questions, underwriters have gotten very savvy in this space since I started out 20 years ago, and understand the risks that alternate asset managers face. And we do everything possible to write contracts and expand the professional services definitions within those contracts to make sure that everything that you're doing can be picked up if there are errors and or omissions, or the SEC comes in and is questioning some of the processes that you're putting forth.
Great. Thank you, Paul. And our last polling question. So you're not off the hook yet, guys. Does your firm track the inherent risks in counterparty documents? Yes, formally through technology. Yes, informally through spreadsheets on an as-needed basis, or only at a time of negotiation. And the answer is yes, informally through spreadsheets, and also only at time of negotiation seems to be the majority. I would think that you'd want to try to get closer to doing it on a more proactive basis, but it's good to see that some are doing it through technology. So that concludes our presentation on part 1 of 3 parts. Part 2 is going to be relationship management and due diligence with counterparties. That will be sometime in May. I look forward to seeing all of you there, as well as additional people that want to join. If you have any questions, please contact us with any of your additional questions that you may have, or some problems that you need to solve. Hopefully we can help you. Thank you all for attending, and we look forward to seeing you sometime in May.
Thank you. Thank you all to the attendees and the folks running this program for us internally. Thank you very much.
Thank you.